Hey everyone, welcome back to Corporate Decoder, the place where we unpack the financial secrets of big companies. And today we are diving deep into D.R. Horton's latest quarterly report. And let me tell you, there are some fascinating numbers in here that paint a really interesting picture of where they stand in the housing market. So D.R. Horton Inc. is a giant in the home building world, the biggest in the US in fact, and this report covers their performance up until the 31st of December 2025. Now normally you'd expect solid numbers from a leader like this, but the housing market has been a roller coaster lately, so let's see how D.R. Horton navigated those bumps. Right off the bat, looking at their balance sheet, as of the 31st of December 2025, we see total assets at around $34.6 billion. That's a huge number, but notice it is actually a drop from about $35.4 billion at the end of September. This dip could mean a few things. Perhaps they sold off some assets, or maybe inventory levels changed, but it's worth keeping an eye on. On the flip side, their liabilities are also down a bit to about $10.1 billion, which is a good sign. Now let's talk money, the actual profit. For the 3 months ending the 31st of December 2025, D.R. Horton reported a net income of about $594.8 million. That's a decent chunk of change, but it is a noticeable decrease compared to nearly $845 million in the same period the year before. This means their profits have shrunk, and we need to understand why. Earnings per S-Hair also took a hit, going from $2.61 down to $2.03. So while they are still making a lot of money, they are making less than they were. The core of D.R. Horton's business is home building, and their revenues from this segment decreased by 9%. They sold fewer homes, and the average price per HOME also went down by 3%. This is a double whammy, affecting both the volume of sales and the price they can get for each home. Interestingly, their new sales orders though were actually up slightly by 3%, but the value stayed flat. This suggests they are selling more homes, but at a lower overall price point. This next number is key, the home sales gross margin. It dropped from 22.7% down to 20.4%. Think of gross margin as the profit they make on selling a home after covering the direct costs of building it. A drop here means they are keeping less profit on each home they sell. They mention this is because they increase sales incentives, like helping buyers with mortgage rates, essentially lowering the effective price of the home to attract more buyers. This is a common strategy in a tougher market to keep sales moving, but it does eat into profits. The rental segment also saw a big change. Their rental revenues dropped significantly by 50%. This was largely because they closed no multifamily units in this quarter compared to over 500 in the previous year. They did close more single-family rental homes though, which is a positive sign for that part of their business. But overall, the rental segment's income before taxes was almost nothing in this quarter, just $0.2 million compared to nearly $12 million a year ago. Now let's talk about Forestar, their lot development company. This segment actually saw its revenues increase by 9%. They sold more lots, which is good news for Forestar itself. However, their pre-tax income was pretty much flat. They are selling more, but not making proportionally more profit. The financial services arm, which includes mortgage and title services, saw a small 1% increase in revenue. What is really interesting here is that their pre-tax income in this segment jumped up by 19%. This means they are becoming much more efficient and profitable in their financial services operations, even with only a slight revenue increase. Their pre-tax income as a percentage of revenue went from 26.7% up to 31.4%. That is a significant improvement in profitability. Looking at their overall financial health, D.R. Horton has managed its debt well. Their debt to total capital ratio, which compares their debt to their overall capital structure, is at 18.8%, which is actually lower than the previous quarter. This is a healthy level, indicating they are not overly reliant on borrowing money. A big story in this report is their ongoing stock repurchase program. They repurchased about 4.4 million shares for nearly $670 million in just 3 months. This shows they are actively returning money to their shareholders and believe their stock is undervalued. They have a massive authorization of $5 billion for this, with still a large amount remaining. Overall consolidated revenues for D.R. Horton fell by 10% to $6.9 billion. This is largely driven by the decline in home building revenues. Pre-tax income also saw a significant drop of 28%. Now for some important legal news, D.R. Horton entered into a consent decree with environmental agencies regarding stormwater compliance. They agreed to pay a penalty and complete a project to improve environmental conditions. While they say this matter is resolved and should not materially impact their finances, it highlights the ongoing costs and responsibilities of large developers. There is also a separate lawsuit filed in Maryland regarding similar environmental issues, and a derivative lawsuit filed by a Forestar stockholder concerning lot sale transactions. While DR Horton disputes these allegations, these legal matters can always add uncertainty and financial risk. DR Horton is navigating a challenging housing market with considerable skill. Their home building segment is seeing some pressure with lower margins and average selling prices, which is directly tied to current economic conditions and affordability concerns. The increased sales incentives, while helping to maintain sales volume, are impacting their bottom line. However, their financial services segment is showing impressive profit improvements, which is a bright spot. Their strong cash position and manageable debt levels also provide a solid foundation for weathering any storms. Despite the legal headwinds and the slight dip in profits, they remain a dominant force in the industry, demonstrating resilience and a strategic focus on shareholder returns through their significant share buyback program. They are clearly prioritizing efficiency and profitability in their financial services, while carefully managing their core home building business. Alright, that is our breakdown of DR Horton's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.